What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team, recently ranked #1 on Wall Street in the 2024 All-America Institutional Investor Research Survey.
Hello, Emily. Welcome, and great to have you on. You and I have worked together since 2010. We've seen some things over the years.
We sure have. Making me feel old, but yes, we sure have. It's been a long time.
So we sit here, we're kind of smack in the middle of summer. We're beginning earnings season. Markets are at all-time highs. We've got the PE of the S&P 500 back to a cycle high of about 22 and a half. We're seeing meme stocks rip. There's been a pretty broad rebound over the last 4 months or so. And it doesn't seem like investors, while they're talking about a lot of concerns, it doesn't seem like the markets are reflecting many concerns. So what are some conversations you're having recently with clients? What are people asking about? What are they focused on?
Yeah. So to your point, we've certainly seen some significant moves lately in the market, and people are a little bit perplexed, I would say, the way that the market just seems to be levitating higher. To your point, the S&P 500 is up almost 30% since the April lows. The high beta ETF, SPHB, is up more than 54%. ARC Innovations up 85%. So we're seeing some significant moves in a lot of different areas of the market. And people are just concerned about, when are we going to run out of steam? At what point do we hit a bit of a wall where the market just can't continue as it's been going? Because we've been basically pricing for Goldilocks at this point. And so I would say you're not seeing a whole lot of bearishness from anybody, but more just a little bit of concern about how long this bullishness can persist. And it has been a bit of a, we've been climbing this wall of worry. And at what point does it peak out?
Yeah, rarely are you going to hear people, even if they are kind of bearish or negative on markets, typically you don't hear them be too outspoken when the market's performing as it has in recent months.
That is correct. That's totally true.
But there's certainly been a flavor to this rebound that is important to acknowledge and talk about, is that this has been a largely, we would, I think, couch it as a macro relief rally. You've seen PEs from the April lows go from about 18 to 22 and a half times. That's a 4.5 point move in PEs in about 4 months. So average that out, it's been about one PE point a month, give or take. We've seen credit spreads go from elevated levels in April back near all-time lows. So yeah, you're not going to hear a lot of people talk negatively in the wake of that. But, that's the question, will the current leadership from meme stocks and ARC and, even those small caps haven't really outperformed in this rebound, they've certainly gone up a lot. And so for this to sustain itself, you almost have to think that PEs have to keep moving higher, at least to see the leadership sustain the market.
Yeah, well, I guess a good question to turn this around on you for a moment is, what do you think could sustain this move in PEs? I mean, we are basically priced for Goldilocks at this point. The tariff risks have, market's not really moving with policy uncertainty anymore. It does seem as though people are looking past a lot of the risks. I mean, what do you think would need to happen for us to be able to get PEs to continue to climb higher from where we are now?
Yeah, well, I guess in the most tautological statement, nothing bad has to happen for things to remain good. The old, if nothing bad happens, this will continue idea. One of the things people have continued to debate is where, of course, interest rates are going. Despite President Trump's continued harping on Chairman Powell to lower interest rates aren't falling. You look at the 10-year bond yield at roughly 4.40 the morning we're recording this on Friday, July 25th. Interest rates really for the last 4 or 5 months have just kind of gone sideways in a narrow band. And one of the things that's come up a lot over the last few years is the fact that interest rates are high, or higher certainly than where they were during COVID, yet multiples have also gone up. And of course, we all learn that there's an inverse correlation, which actually, if you look at the data, it's not always true, between interest rates and multiples. But, we keep getting the question, why are multiples so high if interest rates haven't come down? And I think part of the story that we have to look at is just the volatility in interest rates, or kind of think of it as a second or third derivative. There's been no movement in 10-year bond yields in about a year and a half. And even the last 30 days, the realized volatility of the 10-year bond yield has fallen to pretty much the lowest levels over the last 30, 40 years. So maybe that's, the first step of just the volatility and the noise and uncertainty in the market as measured by bond volatility has certainly come down, which is a good thing, kind of a no news is good news situation. If that persists, things can continue grinding higher. Certainly will keep those animal spirits alive. So I think, in the next several months, we're going to get obviously inflation data, PPI, CPI, prices paid. If those data improve, i.e. come down, or at a minimum don't go up, I think the market, all else equal, can sustain this resilience, albeit at a less violent, rapid pace to the upside than where we've been 3-4 months ago. But, again, as long as we don't have interest rates, inflation move higher, and certainly unemployment not move sharply higher, I think it makes sense to remain constructive on equities. The question is, are we going to continue to be led by meme stocks and ARK and the higher beta names, which have been leading in the last 4 months? And I think that trade's getting a bit long in the tooth, just looking where credit spreads are today. So, we think it's a good time to be trimming some of the risk and not extrapolating what the market's done in the last 3 or 4 months. And, we'll see if earnings season produces some more of a micro market backdrop than where we've been in. But we've got to be, even from the housing sector, there's been a bunch of good earnings, which has certainly brought about a lot of conversation of, whether housing is starting to look better. To me, it looks more of a micro story, better management in a backdrop where rates are no longer moving higher. But I guess I would say you need to see rates move lower to see the economy get a lot better from here. And I would say also to keep the stock market moving higher with this flavor of leadership.
How much do you think the momentum in the market is going to depend on the Fed's move in the back half of the year? I mean, currently looking at Bloomberg's work, Fed fund futures are pricing in a little bit less than 2 cuts for the rest of the year. What happens if it's 1, or what happens if we don't get any? I mean, what kind of an impact would that have, do you think, on investor sentiment in the broader market?
Well, I think if we get 2 cuts, that's probably a backdrop where long-term rates are either flat or even lower. So I think that would be kind of things coming in more or less as expected. Looking at the odds of a rate cut for September, those were at almost 100%, the beginning of the month when the 10-year was, in the 420s level. And we've seen a bit of a backup in rates in the month of July. And those odds have come down to about 64%. So still expecting a cut, but the confidence in the market has gone down. Part of that is, I think, again, inflation did tick up in the most recent report from 2.4 to nearly 2.7 on CPI. So I think it certainly matters. If we only get 1 rate cut, or certainly if we get no rate cuts, that's likely a backdrop where the 10-year yield is higher. And I think that's something that could certainly disrupt this meme stock craze, high beta speculative leadership, a part of the market. I think the story in those areas and this general Goldilocks view in the market is very largely predicated on the view that rates are not moving higher and that we'll get some rate cuts over the next several months.
Right. And then another question on housing and rates. So obviously we've had housing activity be very low and kind of range bound for a period of time. What do you think it would take as far as interest rates broadly and the Fed's actions to really get any type of sustainable pickup in housing activity? I know that housing is a big part of the HOPE framework, and that's what would get you, I believe, more constructive broadly on a sustained, reacceleration in the economy broadly. Like, what would it take as far as rates go to really get that started?
Yeah, I think really just the answer is just lower. Who knows what magic? I don't think it's a magic level where we hit some level of mortgage rates and all of a sudden everyone jumps back in to housing demand just shoots up. I think we have to think of it as a sliding scale or a spectrum. And as long as rates are not moving higher, we could see demand in housing remain okay. If rates come down, particularly if it's from inflation, I think that would be a very good thing for housing. And we'd see a pretty healthy rebound in demand. Again, the housing backdrop in the US is certainly becoming more regional. There's definitely weak pockets in some areas, but still strong pockets in other areas where inventories are not high and prices, really aren't falling. So I think any drop in rates would be a positive. And, I think that goes to some of this reflectivity that we've been writing about within the economy, that any drop in rates, whether it's from a slight uptick from unemployment or certainly low inflation, is likely to ultimately be reflected in better housing activity and just better economic activity thereafter, which if you think about, well, if the data gets a little better, rates are likely to go back up a bit. And then you kind of fall into this reflexive feedback loop, which is, I think, why we've been seeing these kind of mini cycles over the last few years, where a lot of the data has just been sideways. When you look at manufacturing PMIs, they've been sideways. When you look at housing, total home sales in the US, we've been between basically 4.5 and 5 million over the last 2.5 years. And even unemployment has kind of been sideways. So there's no massive macro impulse positively or negatively, which is perhaps why we're not really seeing these big changes in the earnings outlook or the macro outlook. We did see a bit of a pickup in earnings fairly broadly after the bill was passed, the big, beautiful bill. And I think that was, analysts pushing up their numbers in response to some of the positive pro-cyclical aspects of the BBB. But that's going to be more likely a one-time shift rather than a sustained uptrend, certainly broad, if we don't see rates come down and the macro data broadly improve, again, beginning with housing.
That's a great point about the earnings and the shift up in earnings. We are now very much in the midst of earnings reporting season. At this point, we've got about 85% of S&P 500 companies beating estimates. And we're seeing a lot of encouraging news from companies as far as, improved guidance from what original fears, when the tariffs were first going into place and from last quarter. Do you think that this positivity in terms of the earnings is a one time of like what we saw with the earnings estimates coming up after the big, beautiful bill? Or do you think that this is something that we're now likely in a new backdrop where earnings expectations are going to improve from here through the rest of the year?
I think there's a lot less uncertainty now that bill has been passed. We still, of course, have tariff uncertainty in August 1st. There'll be some more news on tariffs, of course. So I think you're hearing less uncertainty in corporate guidance. And, that's the stabilization element of where we are today. And I think you can look at the housing sector and look at some of those builders, which have, largely popped on their earnings reports. And it really wasn't because they were talking about the housing backdrop getting better. And that was echoed recently this week by Sherwin-Williams talking about continued weak demand from a macro perspective. It's really that these companies have just performed or operated better than expected, given that the environment really hasn't changed. So in my view, they can continue to do that perhaps. But if expectations have now been realigned with, I guess, current reality, and that these builders are performing somewhat better than investors feared a few months ago, that's more likely to be kind of a one-time move rather than a improvement in earnings or sales that is happening alongside actual better macro activity in the housing backdrop. Another sector you can look at where I think the story is different is financials. A lot of financial companies are doing quite well, where, of course, there's that view that hopefully rates are going to come down. So that's giving people some foresight to things getting better. But, the yield curve has remained modestly steep, a good environment for banks to lend and make more money incrementally from their lending activities. The uncertainty in the economy has dropped, so capital markets activity seems to have slid somewhat. Again, it hasn't really rebounded strongly. So I think those are two kind of sectors where housing seems to be perhaps maybe a one-off without continued falling rates, whereas a group like financials is an area where things are actually fundamentally getting better, and they could potentially have the upside if rates come down and you see capital markets activity, M&A and banking activity pick up. So I think those are two groups that kind of stand out. And then, of course, you have all the AI tech stuff, which is more somewhat cycle agnostic, that so far has remained pretty strong.
Awesome. And then another area of the market that, looking at Bitcoin, for a moment, which has gotten a lot of interest recently, given how well it's done over the last couple of months. I know you've put out some pretty impressive charts where you look at Bitcoin's performance lined up with several market-related series like the S&P's PE and some other risk metrics. Could you speak a little bit more about what you think has driven the move in Bitcoin and how that fits into this broader Goldilocks backdrop that we've been in recently?
Yeah, I think there's certainly a lot of factors playing into Bitcoin. We've had all of this positive policy news coming from DC, which we've gotten. There's been positive policy news for Bitcoin for pretty much all of Trump's administration thus far. So that's likely to remain a tailwind. The dollar has certainly weakened quite a bit, and there's certainly a cohort of people that buy Bitcoin because they believe the dollar is going to zero and the purchasing power is going to keep getting wiped away. And so Bitcoin, in that sense, is a store of value. So those are kind of more structural issues. I don't think the story there has been volatile that's caused the moves. So, when you look at the periods where Bitcoin has done really well or really poorly, it kind of aligns with market sentiment in general. Whether you look at credit spread or PEs of the S&P 500, if you just look at the last few years, the best periods where Bitcoin does well and outperforms are periods where the S&P 500 multiple is rising, which I think is kind of funny because every once in a while I join a Bitcoin space on X and people talk about asset allocation and they often comment on equities. And I often hear people say, well, look, the S&P is so expensive, which is, I think, ironic because if you look at the price of Bitcoin and the multiple of the S&P, they're clearly extremely positively correlated. Number one, in a sense, if you're bullish on Bitcoin and as long as the current behavior remains the same, when this has been the case for 6 or 7 years, you kind of want the PE to keep going higher. You want investors to become more speculative because, of course, Bitcoin is certainly acting as a speculative investment in that context. So if you're a Bitcoin bull, poo-pooing the S&P 500's valuation levels doesn't seem to really make sense given the relationship. And then moreover, given that Bitcoin is not exactly an income generating asset, it again seems a bit ironic to comment on another asset's valuation when you're owning an asset that essentially can't be valued and is in all ways very speculative. So, yeah.
That's a great point. And maybe not as much diversification as you might think. I have seen those charts that you were talking about with Bitcoin lined up with the PE of the market and beta's performance. And they do, shockingly similar. They're tick for tick nearly. So certainly I hear what you're saying. I think that makes a lot of sense.
So Emily, let me toss some questions your way. So you do a lot of great work every quarter looking at what's happened in the markets and pointing out some nuances. If you look just in the last 3 to 4 months at the market's rebound, what are you seeing that I'd say is consistent with market rebounds historically? And are you seeing anything that kind of stands out as being inconsistent with the market up as much as it is in the last 4 months?
Sure. That's a great question. As far as what's consistent about this rebound compared to historical market rebounds, certainly the fact that we're seeing high beta outperform as a factor. This has been a strong high beta move. That is what you always get when the market bottoms. So that's something that is very consistent with history. And, we're seeing certainly some areas that are different, and every cycle has its nuances. I would say one of the things that's a little different about this cycle is that even though we're seeing high beta as a factor do well, we're not seeing smaller caps do well. Basically, at this point, the S&P 500 to IWM, so large to small, is at new highs. And so oftentimes when you see a trough in the market, you see small caps, which tend to be the most cyclical area as far as size and style boxes go. They tend to be the leaders. And we're just not seeing that in this backdrop. It's actually been large growth. That's been the factor that's done best over the last couple of months. If you look since the trough on April 8th, large growth as a size and style box within the S&P indices, it's up more than 35%, whereas the small cap indices are up about 25%. So significant leadership in larger caps as far as that's concerned. We also haven't seen stocks with negative earnings outperform as much as you typically do, as much as you typically see in a rebound. It has certainly been beta that's been working, but it's not necessarily the lowest quality beta. So that's a sort of something that's a little bit different about this cycle. And I think part of it has to do with the fact that, the rate story, we haven't seen any real decline in rates that would get some of these smaller caps, more lower quality areas to benefit. And so we've been in this period that's been very range bound rates throughout the, basically throughout the sell off and the rebound. We've been in a pretty tight band. And so we are seeing some nuances as far as what type of leadership is working. That makes it a little bit different from historical episodes.
Yeah, and I don't think people necessarily can see that and always see that nuance, because you look at the IWM, the Russell 2000, it's obviously up quite a bit from the lows. On the institutional side, certainly on the sell side, we're always looking at relative performance, because that's essentially a way to talk about positioning. And of course, whether you're a hedge fund or a long-only regional fund or ETF, active ETF manager, your goal, of course, you want markets to go up, but ultimately you're trying to beat your benchmark if you're long only, or you're trying to beat your shorts if you're a hedge fund. And if you've been overweight the small cap indices relative to large caps, which again, traditionally you would think would work really well in a market that's rebounded 4.5 PE points, you really haven't made any money or gotten paid, whereas like something like ARK, which has a lot more beta, arguably a lot more speculation, is up tremendously. So it's the small nuances. And I think, part of it is just that, unlike the rally in the market in late 2023, which I would argue was pretty much 100% predicated on rates falling, or took place while rates were falling, from a market that declined on the back of higher rates. And that led to a huge pop in the relative performance of small caps. This one was really about tariffs and the fear of recession, or essentially growth fears. And so this rebound in the market hasn't coincided with lower rates. If anything, rates really haven't moved point to point. And so I think that's part of why you're not seeing the small cap, kind of that full-blown, broad-based risk on leadership in small caps over large caps, because we've resolved essentially a growth scare, and interest rates really haven't come down. And if you look at the Mag 7, for example, from April 8th, they're up about 42% from their lows, whereas the Russell 2000's up only about 27, 28%. And I think that has to do with just, again, the fact that rates weren't falling during this rebound, and it wasn't about lower rates, and also just the composition of the S&P 500. I mean, with NVIDIA up as much as it is, that has a huge bearing on the relative performance of the S&P 500 versus really any index. So going forward, it seems that small caps, unless we get rates to start falling and get better CPI numbers, and that's certainly an environment where small caps can outperform. But now with credit spreads near record lows, multiples back at the highs, and pretty much markets pricing in no risk, it's hard to say that you want to either chase or add to that position in small caps, given that they've kind of missed their window of traditional leadership.
So given where we are today and the fact that we've seen all these risks priced out, and we've sort of, as you said, missed the window for some of these riskier, for the small caps to outperform, what is your recommendation for investors going forward as far as what to do here? I mean, do they, are there certain areas of the market that they chase the huge gains that we've seen, or would you say that it's just time to pare back some of the risks, given that we've already seen so much benefit from being in some of those riskier assets?
It's a tough question to time, because markets, always tend to overshoot on both sides. And you could argue we overshot to the downside, and you could perhaps say we're beginning to overshoot to the upside. But markets can stay irrational longer than you can stay liquid, that old saying. So kind of think more of a catalyst perspective. So we would argue to start trimming risk and not chase these names, which I know is hard to accept at a time where you're seeing all these meme stocks pop and the markets just broadly drift higher. But the risk reward, you have to acknowledge, today is nowhere near as attractive compared to where we were 4 months ago after a huge sell-off, or even 2 months ago or 1 month ago. when there was still concern around a lot of different aspects of the macro outlook, whether it's rates, inflation, unemployment, or tariffs. So we would not be chasing that. Of course, it could persist if speculation and animal spirits just continue to run rampant, which is, of course, always a possibility. But we're always thinking in probabilities. And I would say this flavor of leadership is possible, but increasingly less probable. And any impact, any rise in interest rates, I think will be met with potentially a couple of nasty pullbacks in some of these more speculative areas of the market, which again, we've seen time and time again over the last 3 or 4 years. And what we are seeing now is that while interest rates really haven't moved a whole lot, even small changes day to day are being reflected in market breadth. So for example, on Thursday, rates were up on the 10-year from 435 to 440. So not a big move in the context of macro, but small caps at one point were all, I think, as much as 2%, and ended the day a lot lower. So that's, I think, the near-term risk, not a big bearish, broad-based negative call on equities, but just this is the time to start trimming risk. There's an old, one of the famous things about, I think, Jack Welch at GE is that he was known for trying to cut costs when things are good, which is kind of counter to how people typically act. They typically cut costs when things start getting bad. And so in that spirit, you want to be trimming risk when things seem to be good and market can do no wrong, rather than waiting until, the VIX spikes to 20 and everyone kind of quickly shifts to a more neutral or negative outlook on markets. So that's kind of where we are today.
Michael, it sounds like sound advice. Let's wrap it up there. And as we look ahead to next week, we got the Fed coming up next week. What else are you going to be focused on as a week ahead?
Yeah, I think the near-term risk to markets is a slightly increase in interest rates. So I'm going to be looking at data that are typically have a big influence on rates. And next week, we're going to get a bunch. Of course, yes, we'll get the Fed. So that perhaps will cause some bond volatility. I would imagine that Powell is not really going to sound any different, right? In the last month, CPI measures went up. We're from 2.4 to near 2.7. Prices paid metrics are high. Trump is still, striking these deals with higher tariff levels or some levels of tariffs. And so I think he's going to continue to reiterate the message that we're just going to have to see, the data pass through to see how much of a hit from tariffs we're seeing. And of course, again, in earnings and even the CPI data, we are absolutely seeing the impact of tariffs. The good news is that there's a lot of offsets there as well. But I think Powell's going to reiterate that. So that'll be next week. On the 29th, we're going to get the JOLTS data, which tends to be a very influential data point for interest rates. If we see JOLTS remain firm, likely to see rates back up on that. If we see a big drop in job openings, that'll probably be met with a strong market reaction in both bonds and stocks. Powell often talks about the job openings data. And we will also get on the 1st, we're going to get payrolls as well. So of course, that'll be Friday. That's always a market moving event. And then also we're going to be getting the ISM manufacturing index. So a lot of macro data next week at a time. We're going to get a lot of earnings. So in a quiet week for the summer, I think it'd probably be seasonally a little bit more noisy and volatile than what we're used to.
So you're saying it's not a good week to check out and hit the beach. Is that what you're telling me?
Well, it's always a good week to check out at the beach, but I think you're going to want to investors are going to want to pay attention to markets because there's so many catalysts, nearly every day next week that could create some volatility. And, again, the odds of all of that data and the Fed meeting all being hawkish or all being dovish are probably low, but there's always a potential. So we could see either the market rip if we just get a bunch of dovish news and sentiment from Powell, or we could see a pretty ugly pullback in equities if we get a bunch of hawkish data. So at a time where markets are up a lot and investors are fairly optimistic and valuations are high and spreads are tight, it's not a time to hit the beach without that laptop.
All right. Sounds good. Well, I think let's leave it there. Thank you so much for having me on. It's been a pleasure.
All right, Emily, you too. And to all listeners, hope everyone's having a great summer, and we'll see you next week.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro, If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.